Welcome to our event today. We are with Keith Davidson from CLA, CliftonLarsonAllen, and he is going to go over some financial management in a pandemic. You know, here at the DEC, we're trying to provide as many resources as we can for you today, and all throughout this time, we know it's trying for entrepreneurs and it can be a little uncertain right now, so we want to be able to provide resources to y'all and help y'all through that time. So that's what we're doing today here at this webinar, and Keith will be a great resource to you. And as we go through this event, feel free to send over any questions in the chat over on the side, and Keith can run through them as he's going through it and answer them to the best of his ability. So with that, I will hand it over to Keith and let him get started.
Thanks, Delaney. Good to be here. Thanks for having me. I'm Keith Davidson with CLA, as Delaney said. I lead the fractional CFO and outsourced accounting and bookkeeping practice for CLA in Dallas. CLA is a large national accounting and consulting firm. We do everything from what I do to your typical tax, audit, valuations, and other consulting type work. I've done a few of these in the last week with a couple of different organizations, with tech being my favorite, of course. And you don't really need another person to tell you how unprecedented this time is. If I hear someone else say unprecedented, I'm going to scream because I've heard that word 20 times in the last week, and everywhere you see it, every article you read, you hear people talk about it. But there is a lot outside of the pandemic itself. What I think is probably more important is just the news left and right on what the government's doing from a financial point of view, what your customers may be doing, what your investors are doing, what your vendors are doing. There's news coming from everywhere. And so what I want to talk to you about today is how to think about financial management in a time like this. It's multi-pronged, and there isn't an attorney, a CFO, or a consultant that knows all the answers right now, especially as it pertains to the government programs. I mean, most of those they're building the airplane in the air as we speak. However, I've been up past midnight for the last week helping clients, work on their loan applications, talking to their banks, talking to nervous and/or pissed off investors in terms of what cuts the company is going to make, how they're going to pivot, you name it. And so while no one knows all the answers, I want to share a little bit of what I've learned more about the government programs, but also too how I'm approaching this with clients and startups and small businesses I'm working with. And so, probably 3 sections for today, and there's no slides because I think if I would have made slides last week, I would have had to redo them today for all the different news that's gone on. So I'm just going to talk straight to you guys, and please ask any questions along the way in the chat box, or at the end I'll give time, and anyone who wants to speak up or chat then can ask questions, and I'll go through and answer them. I did an event with a group I work with last Friday, and I answered questions for 2 hours. So I'll do that again today if that's what you guys want. But outside of that, I want to talk a little bit about the government loan programs. I know that the DEC had an event focused on the SBA loans last week, but for those who either didn't attend or if you had more questions, I do want to cover those. But I will be a little bit briefer than an hour-long talk just on the loans themselves. And then I want to talk about the short-term strategy involved with just how do you manage cash in a time like this. For the startups in the audience who are funded or soon to get funding, cash is something you have to manage all the time. But right now it's even more pivotal. And then lastly, I want to talk about how do you message and talk to current and potential investors about this. There's still investor activity going on. Investors are still investing in startups, and current startups still owe accountability to their current investors and to their board of what's going on in the company. And so I want to talk about that as well. And again, please feel free to ask questions throughout. I'll probably pause here and there to read some questions. So don't feel like you got to wait to ask. Just ask, and I'll scroll up and I'll cover them on there. So with that, let's get started and talk first about the government loan programs. And for you guys, most of you, now I know some of you may still be considered self-employed or even freelancers, and some of you may be much more of a small business. But generally, the two types of loans right now is the economic injury disaster loan through the SBA exclusively, and then the paycheck protection loans, which is through it's part of the SBA, but it's actually exclusively through banks. Now, I made a post on LinkedIn about this yesterday. It's been a little aggravating that if you Google any of those programs, and look up a entrepreneur.com or an inc.com or a money.com article, you're going to get 2-3 paragraphs about the loan and what it entails. And, that's, I would say, nearly impossible to do with a bill that's over 800 pages. And so the bill is a lot more nuanced and a lot more particulars of what's going on with those loans than what you would see just if you read one of those articles. And so while I'm not going to read 800 pages today, I do want to cover a little bit more in depth what the latest is for both of those. And then two, what probably the biggest questions I've seen asked from either clients or people I've worked with, and how and what the government's latest guidance is on that, which literally has changed in the last day. And so at any time, ask questions on those. But we'll first talk about the economic injury disaster loan, which I call the EIDL loan for short. Now, this loan, the EIDL loan is really not anything new. So if for some reason, let's say, a tornado hit most of Dallas and you were impacted by that, you would be able to get the same type of loan. Now, they've changed a lot of the restrictions and a lot of the, they tried to make this easier to get, but the EIDL loan is really nothing new that the SBA offers. And so what it is, it's a loan that's up to $2 million that's supposed to be primarily for working capital and even some fixed debt as well. It's an interest rate of 3.75 for businesses and 2.75 for nonprofits, and it's going to be a 10 to 30 year a term, and even the first year is going to be deferred in terms of payments. So yeah, that's a pretty big hefty loan if you can get it. Now, the biggest part of this loan, and this is where kind of the first clarification I want to make, is that the part of this loan when you apply is you can get a $10,000 emergency grant with this loan. And so if you've applied for that in the last week and you haven't checked that box, try to go redo it. If you're going to apply for it today or this week, then make sure you check that box, because that's a $10,000 grant that you can get funded within a few days that you don't have to pay back, even when you get that loan. Now, we'll talk about later with the PPP loan. If you end up getting that one, then you will have to pay that 10 grand back. But I know people who are applying for it still in review and have already gotten their $10,000 through the SBA. And so most of you probably would fit the description to be able to apply for that one. So that's a really important one. Now, typically with an SBA loan, you have to submit, tax returns. You have to submit personal financial statements. You have to do a lot of different detailed reporting. The SBA have been scaled down. The requirements for that have been scaled down tremendously to where you don't have to send additional documentation at this time. The thing that I've seen that they'll want to know is your last 12 months revenue and your last 12 months cost of goods sold, because the objective of that is to try to replace lost gross profit. And so if you have $1 million of revenue and $500,000 of COGS, and they see you're averaging $40,000 to $50,000 of gross profit a month, in theory, they're going to try to replace 3 to 5 months of that. That will coincidentally go to paying operating expenses. But the good news about that is that could be a 30-year, 3.75% loan, which outside of a mortgage is unheard of. So that's why mostly for the businesses that have been in business for a while and have consistent revenue, I certainly do recommend that one. Next, once you have the idle, the next loan is the PPP loan. Now, a clarification here is that you can get both of these loans. However, you have to use them for different purposes, and I'll talk about that in a second. Now, the payroll protection program loan is up to $10 million, and the difference between this and the SBA is, the idle loan is that this loan is actually only through banks. So I've seen a lot of people confused over this. Even my hairstylist is confused about this when I talked to him, as he said he was going to do the PPP program and he's doing it online through the SBA. The PPP is only through banks. And so for small businesses, that started on Friday. And for independent contractors and self-employed, that starts this Friday. And if any of you have already tried to do that with a bank, as you've seen, it is a hot mess right now. The banks are completely overwhelmed. The guidance they need to even fund the loans isn't even final yet. And so if you've applied or haven't applied, there's no one that I know of that's even gotten funding yet. And if you've tried to use a large bank like Wells Fargo or Bank of America, you've probably been turned away. Wells Fargo said over the weekend they have reached their capacity already. Some banks, like Bank of America, aren't even doing it for non-customers. And so that's one that I recommend. If you don't have a relationship with a local bank, in the future, that's one reason I recommend one, because the most people I know that's had success has been through local banks. I would give you a recommendation, but the local bank that I usually work with my clients is already full too. And so there's still some out there. I've heard good things about Lendio being a good source. And there's a couple other banks around Dallas that are still offering them. But that's one, if you're looking at applying, I would recommend trying to get in that line as quick as possible, because most experts think that the funding for those loans is going to run out within the next week, if not sooner than that. So the payroll protection program, though, what it's designed to do, so different than the idle loan, which was more geared toward replacing gross profit, this loan is primarily meant to cover payroll cost. So the calculation for that is taking either your last 12 months or your calendar year 19 payroll, unless you're a seasonal business, then it's a little bit different. But taking the average monthly payroll cost and giving you a loan up to 2.5 times that amount. And so with that, a couple of clarifications. One, independent contractors. So if you're a small business and you have independent contractors, whether it's a lawyer, my firm's considered an independent contractor, that is not eligible for the calculation of this loan. It's similarly, it's not part of what you can pay to get it forgiven as well. And I'll talk more about that in a second. Also, if you have employees that make over $100,000 a year, that amount is capped at $100,000. So for example, to make the math really easy, if you had one employee who made $5,000 a month, you could get a loan for $5,000 times 2.5 for the loan amount. If you had one employee and they made, let's say, $20,000 a month, you would only be able to get a loan for $8,333 times 2.5. And so that's how it would cap it. However, for those with multiple employees or even ones that pay health insurance, whether it's directly or through like a PEO, there is no cap on those costs. So in either example I just gave you, if you spent $5,000 per employee on health insurance, that is all part of the loan amount for this program. And so that's part of the good part of this program is you can, in theory, get about 2.5 months worth of payroll in this program. The best thing about this program, though, is that different than the idle loan, this program, depending on how you spend that money over the 8-week period, all of it can be forgiven. If you spend all of it on payroll, or at least 75% of it on payroll, then it can all be forgiven. Outside of payroll, you can spend it on things like rent or mortgage interest, You can even spend it on interest related to other debt. You can spend it on utilities for it to also be forgiven. However, only up to 25% of that amount can be used for non-payroll items for it to be forgiven. You could spend all of it on whatever you want, but for it to be forgiven, you have to spend at least 75% of it on payroll and 25% on utilities, rent, and other things like that. An important distinction to make when it comes to that forgiveness and for the program overall is that all this goes through banks. So even with the clarification I told you, the Treasury came out and said independent contractors are not part of the calculation. I know some banks that up until Friday were saying it does. At the end of the day, the bank is what is the ultimate interpreter of how your loan's calculated. So if you calculate a loan of $100,000 and they calculate one of 90, that's up to them to interpret it that way. Similarly, with the forgiveness isn't automatic. The forgiveness isn't something that you have to prove that you're going to get automatically. You actually have to go back to the bank 8 weeks later and apply for that forgiveness. And so you'll have to document what you spent, the money on, which will be a little difficult because it'll be in the same bank account as your operating activities. But to be able to show that if you had a $100,000 loan and you said you spent it on payroll, well, they're going to want to see payroll reports for the next 8 weeks to see that payroll really was $100,000. But you'll have to do that with the bank, so the bank can then apply to the government to get the forgiveness for that loan. And if it's not forgiven, so this is another distinction different than the EIDL loan. If it's not forgiven, it's a 2-year 1% interest rate loan. So that's something that's a lot different than the EIDL. I know some businesses that wanted to use this as just another loan, which you can, but keep in mind that's a 2-year loan, and even though it's a low percent interest rate, it's still something you got to pay. You got to pay in 2 years. Another distinction for both of those. So going back to my example for the EIDL loan, let's use the example I used earlier. Tornado hits Dallas. It's declared a disaster area, and you go to the SBA to get an economic injury loss loan. Typically, those loans, you have to demonstrate that is your only option. So in other words, there's no bank that would lend you money, which is usually the case for those type of loans. They've relaxed all those requirements. You don't have to have the ability to bank elsewhere. You don't have to sign a personal guarantee unless it's over $200,000, which is very important for, I know, many of you entrepreneurs and many small businesses. That's going to be something that's a problem for you before you have investors or even after, is that it's going to be hard to get credit for that business unless you sign a personal guarantee. And so in this case, for both of these, you do not have to sign a personal guarantee unless, in that case, EIDL, it's a loan over $200,000. That's when you'll actually have to sign a personal guarantee. But to be able to take a $200,000 loan with a small business and have no personal guarantee, that's frankly unheard of. What that means for you that don't know, and I'm not a lawyer, so please consult your attorney. But basically what that means is if you had Acme Co., that was a corporated company, if it had a $200,000 loan with no personal guarantee, if for some reason that loan couldn't be paid, Acme Co. could go bankrupt, and it would not impact you as the founder and owner of that business. Now, of course, as any attorney would tell you, you have to make sure you're not living out of the business, because if you commingle personal expenses or break some of those corporate veil rules, then you will find out very quickly how guaranteed that loan is from a personal standpoint. So those are really, I would say, high overviews of the two government loan programs. I'll be happy to take some questions on that before I move forward into some other FAQs of it that I've been asked and I kind of been keeping track of in case you didn't think about it, or any that you have right away. I have one question. I was in the middle of a Delaware C Corp incorporation process. Are there options available under these loan programs to support new startups? Yes and no. So it really depends on how long you've been at it. So if you've paid payroll for the last 4 or 5 months, even if you weren't a C Corp, the payroll protection program is available to you. The calculation is a little different if you haven't been around for a year, or if you're a seasonal business. But these are designed to help even startups. Usually startups get left out in the cold with stuff like this, but that is available to startups. Now, something additionally, so one of my clients they're a startup, but they're the only employee right now, and they're paying themselves payroll, but they've only been doing it for like 3 or 4 months. Well, what he's doing is he's going to try to get the purchase protection or the payroll protection program, but he's also going to get unemployment. And so that's one thing where it's $600 a week. And traditionally, independent contractors, self-employed, gig workers are usually also left out in the cold when it comes to unemployment. But one of the new impacts of the law is that those people are now entitled to unemployment as well. And so he's going to try to get the payroll protection program to cover what he's been paying himself over the last like 4 or 5 months. But he's also going to look at getting unemployment as well, because he's not going to pay himself anything over this period. But he's going to use the payroll protection program as more of a loan, because he's right in between funding from another seed round with his company. So I'd say there are options there, AJ, to consider for new startups. I say if anyone else has any questions, there's a couple of questions I've been asked a lot of here lately. Do the payroll protection loans cover sick leave? Yes, that's part of the cost that can be forgiven for that. So that is part of it. Another one I got asked a lot last week, which I was surprised, is are you eligible for this if you use a PEO to do your payroll and benefits? And so for those of you who don't do this, I highly recommend this to all my startup clients, is a company like Just Works. And so typically, let's say me and you had a company in ourselves. If we try to get health insurance, you're not going to want to see what that price tag is. I mean, that's several $1,000s a month per employee, given how small we are. Well, if you use a PEO like a TriNet or a Just Works, they combine everyone all their clients into one company, so you can get the type of benefits I can get at a national firm, or that you can get at Walmart, or you can get at GE or large companies like that. And so you can pay premiums that some of you that used to be more in the public company world or used to. Well, if you're a small business and use that, there is no payroll tax report. There is no payroll report, because your W-2 is going to say their company's name. And so what Treasury's guided over the last week is your proof of that is just your payroll register that you get from them, that shows what everyone was paid and what you paid as the employer. And now if you only have 2 people in your company, I still recommend this as an option, as an aside. But I know some clients of mine were confused because the banks were asking for payroll tax forms as proof of their payroll. And if you have a PEO, that's not something you'll get. A couple more questions. I'm going through my Rolodex right now, ones I've been asked over the last week that I think I needed to clarify. The other one I'll mention is, and this is unfortunate, I think, and I'll talk about why, but so not allowing independent contractors as part of the calculation. Selfishly, I wish my clients could get a forgiveness for what they pay, myself or attorneys or others. But I think this is what shortchanges the startup community, because startups use attorneys, outsource CFOs, accountants, outsourced marketing, outsourced IT, outsourced HR as extensions of their business instead of employees due to the cost savings. So I understand those companies, including mine, have options for loans and programs too. But I know some startups that are, the Paycheck Protection Program doesn't really cover them for some of their true costs that they have. Again, you can use it for those options or those type of costs, but that's going to impact how much of it can be forgiven. Any other questions on the government loan piece before we move on? I'll give everyone a quick second. Okay, feel free to type in, even if it's about this later on, we can still cover it. So the next part I want to talk about is just thinking how to think about short-term cash strategies. For startups, this is something you should always be thinking about how much cash you have. I started with a new client probably about 2 months ago, and it's a pretty big startup. They've raised about $5 million to date. And one of their issues in their accounting group was that the CEO never knew how much cash they had. It was always a fire drill to understand that. Reports were late on a monthly basis. The CEO was always wondering what bills they could pay. And so, yeah, there's some sloppiness there, but I don't think it was anyone intending not to know what their cash balance is. But I think from a startup point of view, I want my founders that I work with, I want them knowing how much cash they have daily. I want them thinking about it nonstop, because as a startup, it's the most important thing you have. It's more important than a P&L. It's sometimes more important than your revenue growth. And it's certainly more important than some of the metrics that you're going to use to justify additional investment. But I'm surprised often at how little it's focused on, to where, there's a burn rate of $50,000 a month, and people don't realize that, and they're not even considering that when it comes to spending. So right now, probably more than ever, to be aware of your cash, but also think about how to manage that. So for small businesses, I think that probably the crisis management part for you is to really chart out these next 2 to 4 months and understand what this is doing from a revenue standpoint. And I mean, really be pessimistic. This is not the time to try to be brave and assume you're going to keep 95% of your business, or that you're going to grow the way you thought, when you may have half your business just go away. One of my clients, 90% of their customers are restaurants. So they have a big problem on their hands. And so part of what our exercise has been, let's throw out the budget we had, let's throw out the last 6-12 months actuals, and let's start all over for the next 3 or 4 months. What's that revenue picture really like? And then kind of the biggest part of this is, what are your true variable costs in this moment? Now, I know in a manufacturing environment, it's simple. It's your direct materials, direct labor, and you know what you're making on each widget. But even with a consulting-based or a SaaS-based business, you have more variable costs there than you realize. And so understanding how that relates to that revenue and what you can do without in that short term is extremely important, and especially important on the investor side, which we'll get to in a minute. But understanding what that is in the 3 month and coming up with a couple of different contingency plans. The first one is, based on what you know today, what do you have to actually start or do today to even hit that budget? Whether it's a salary reduction, whether it's furlough, whether it's delaying payments, which we'll talk about in a minute. You need to know that. And then you also need to know what kind of that phase 2 is. And so if you don't hit that next 3 to 4 months, what do you do then? And what's the trigger point on when you do that? So if you have a new 4-month budget to try to survive, this pandemic, do you go to phase 2 once you miss the first month? Once you miss the second month? What are the triggers there? And so if you're not talking about that now, you need to start that today. First, you probably need to go apply for the loans first, but you need to do that second to understand what you need to cut or what you need to shift differently in your strategy to get through this time. A big part of that, it may be obvious, but it's if you've been in a startup and been working with startups as long as I have, I always joke with people, the best way to pay cash is to just not pay your bills. And I say that half jokingly, but anybody that works with startups, including myself, I mean, you don't always get paid on time. And that's part of working in this ecosystem. And so if you're dealing with large vendors like Salesforce, you know, Zoom, Bill.com, any of these big vendors, even if it's just a little bit each month, now's the time to call them and either ask for a discount or ask for extension of payment terms. Most of my clients have had really good success with a lot of these big national vendors. One of my clients pays about $10,000 a month with Salesforce. They got a 50% discount over the next 4 months. And so that's huge. I mean, that's $20,000 that they can use for something else. And so if you're not doing that, I definitely recommend doing that with all of your suppliers. Now, I would also caution you, though, I would caution you against doing that too much, because one person's AP is another person's AR. And so you don't want everyone doing that to you. And so if it's a local person, my own opinion, I wouldn't do that. I would try to keep them as whole as possible, just because you don't want anyone doing that to you as well, since you're the small person. But Salesforce, you know, last year they had Taylor Swift and Metallica at their convention. I don't really feel sorry for them and how much cash they have on hand at this point. So I would say, by all means, try to get people like that, you know, heavily discounted over these next few months. And then another part of that related to AP is considered cash, a cost outside of the P&L, so capital. So for a lot of you that are well versed, that may seem like a no-brainer, but you'd be surprised how many people get so focused on the P&L, so focused on revenue, so focused on your expenses, that they look at their net income or their operating profit and think their burn rate's, you know, $20,000 a month, but they forget they need to pay a developer $100,000 for the next wave of an app development. And so pay attention to that as well, and also consider how much of that work can be scaled back. If you're dealing with a developer, which I know some of you are, how much that can be scaled back versus your current plan, but also still allow you to hit targets. I mean, no investor is going to want you to ship out MVP by 6 months. But if you're already post-revenue and you're having a phase 2 of something, it may be something you can cut back on to try to weather this storm. Question from AJ. Speaking of burn rate, are there any verticals that you've seen as having growth potential during this time, outside of the commonly cited telehealth, remote work, SaaS, et cetera? Yes, AJ, I'll get to that one in a second when I talk about investors, because I think it'll dovetail nicely into it, but that's a really good question. So speaking of that, let's get into the investor part of how do you talk to investors, a board, potential investors at this time. So one of the questions I've gotten the most over the last couple of weeks is from either clients and either people I'm talking to about becoming a client is, are investors still making deals? Are they still taking meetings? The answer is yes. Investors are always looking for a good deal. I would even say, to be provocative, I would even say that this is probably the best time I've seen in a long time, just from the simple mechanics of how an investor is going to look at a discount rate of a startup versus they would normally. So when you think about an investor, if I have 100 grand to spend, my option isn't you or nothing. Doing nothing is certainly a strategy, but you're not my only option. I can put that $100,000 in a treasury bond. I can put it in Amazon. I can put it in Coke. There's a lot of things I can spend that money on. And so the reason a person invests in startups and wants a high return isn't just because you're a startup and you have that ability. It's because they require it. Just from a simple, the risk always equals the reward. But I'm not saying they're going to change the discount rate on you, but their perspective of knowing how risky that $100,000 could be in the S&P 500 right now versus a startup is a lot closer than that was 2 months ago. And I think for some startups that can be in your favor. So yes, they are definitely taking meetings. I've seen deals happen. Now, one of the interesting things I've seen is I had a client who they signed a $2 million term sheet about 2 months ago, and the diligence has progressed fairly well. But once they got to close, the VC firm actually needed another week to close because they weren't liquid enough to actually finish the deal. Now, it's been taken care of since, but that's a standpoint where if you have a VC firm or you have a high net worth individual, they're getting killed in their own portfolio right now outside of startups. And so do they even have enough money to actually fund you is something to keep in mind. But the meetings are still happening. But either way, whether it's a meeting you have scheduled or whether it's current investors you want to talk to, the biggest thing, and this is, I take this from when I did investor relations at a public company, is you got to be transparent. You got to admit what you don't know. And right now, you don't know anything. And so the worst thing you could do right now is talk to your investors about everything. Tell them that you know everything and you're confident what's going to happen, because they're going to know right away you don't. Now, there are things you do know, because this has gone on for a few weeks now. So if you've seen success in spite of all the odds in the last few weeks, well, they need to know that. Now, I don't think you can safely project that for the next 2 or 3 or 4 months, but I think that's a good piece of information to know. Secondarily, if something's not working out, you'll know right away how you can project that. You can always project pessimism. It's optimism. I wouldn't always project out to an investors, but just being transparent and having that conversation with them, I think is a really good step. And it's something you should be doing anyway. If you're a startup and it's mid-February and you miss a really important target, the quarter end board meeting is not the time to have that conversation with investors. You need to have it as soon as you know it. And that's going to, in the long run, really build goodwill with the investors and make it to where when you need future rounds, they're going to feel like they trust you with the money, even if it doesn't work out the way you always project it. Next, part of the strategy with investors, whether it's potential investors or current investors, is, it's been frustrating for me personally, because whether it's clients I work with or other companies I know, and even my own firm at times, is, what's being on the defensive about what's going on. So the news is bad. We got to cut this. We got to do this. This is not working out. I've seen a lot of woe is me, frankly, from almost every company I work with. A lot of violin playing with some of the bad news. This is a time to be aggressive and actually go on the offensive if you're a startup. To AJ's question, there are areas having growth potential. I've talked to a couple of people in the last week who have startups focused around driving retention and engagement with restaurants. What better time to show the value of retention, customer retention at restaurants, than right now? I'm not talking about the large chain restaurants, but I'm talking about local restaurants here in Dallas that we love, that, like, let's say even like a Mi Cocina. It's a chain, but it's not really a national chain. Well, wouldn't they love a way to be able to talk with their customers and keep their customers engaged and give them incentives to come back outside of emails or anything like that? So I know a couple companies that are working on ways to reach those types of customers, or ways for the restaurants to even broadcast information to their customers. Because right now, if you happen to be on an email chain with them, you may get information, but you may not. Another one of my clients focuses on marketing strictly for restaurants. So yes, last month was a scary time for them, but now they're helping their clients go on the offensive and help them understand, what the angle is here in this environment and what they can do to actually drive a better revenue. So there's a lot of angles like that right now. If you do anything that's going to benefit the restaurant industry, savvy investors are going to understand it. They're going to need something. If you do something that is around the event industry, and I don't mean just a place, Zoom and virtual events like the software we're using now, but I mean if you typically do physical events and you're coming up with unique ways for those companies and those events to reach their user remotely, that's a good business to be in right now. Other ones, one of my main clients right now is a competitor to Blue Apron. So right now, their growth is off the charts, and they have investors that told them to go pound sand a year ago reaching back out, asking if they can get in. And of course they can get in for probably a fourth of the terms they got when we were desperate a year ago. And so if you're an investor or if you're a company like that, take advantage of that. But even if you're not something as linear as something that helps restaurants or something that helps sports teams or something like that, I think you can still take advantage of that and demonstrate why you're going to be stronger than ever. One of my clients had to unfortunately go through a lot of layoffs a few weeks ago because they couldn't wait for the loan to get here. Well, what we've learned in the last few weeks is we didn't need all those people. And I hate to say that. I don't want to be crass about impacting people's lives. But from the investor point of view, they realized they didn't need the people they had, and they were too top heavy. And they also realized there were other luxuries they had as a business that they didn't need anymore. So although their business is impacted slightly by what's going on, they're messaging to their investors that despite assuming the next few months is as bad as we think it can be, we actually think that they can get the cash break even about 6 to 9 months quicker than we originally thought. And that's tremendous news for the investors. Even if we're wrong, even if it doesn't work out that way, we've shown them, we've taken a proactive look at their org structure to get ready for this. I think what you're not going to get sympathy from, so you'll get sympathy if it just doesn't work out right now and your revenue is just taking a bath because you're offering something that the market just doesn't need right now. So for example, if you're a competitor at Open Table, you could not have picked a worse time. So I think Resi is a fairly new Open Table competitor. They could not have picked the worst last year to launch because all their momentum is going to be shot for the foreseeable future. But for companies like that, or even ones that are slightly impacted, you don't want to miss targets and then tell investors that, okay, now we need to do something. Showing that proactive nature of how you're approaching it is really going to buy you a lot of credibility with investors. And for the most part, that's all you can hope for with investors because they know your forecast is wrong. They know even the financial model we built is wrong. But what they don't want is where they feel like you don't know the business, where you're not able to take the steps necessary to run the business. That's how you can go from getting funding to either not getting funding again or getting funding, but getting terms that are just going to make it really not conducive to what the kind of business you wanted to run. So AJ, I hope that answers your question. Any industry that can benefit restaurants right now, or any industry that can really do something space or in the or related to the sports and entertainment industry, I think is really hot right now. Outside of the ones that you mentioned on telehealth and remote work and SaaS, but even some of those SaaS ones. I think it really depends. I think it really depends on the industry right now on if that's necessarily going to be a good product in the future. So we got about 15 minutes left, and those are the main 3 topics I wanted to cover. Please feel free to pepper me with questions. It didn't even have to be about these 3. I mean, since I have you, if any other startup related finance question. I'm more than happy to talk about or give any feedback if there are questions. Any other questions out there? For those that don't, or if you think of a question later, please feel free to find me. You can find my LinkedIn link on my profile here on this software. Happy to help anywhere I can. I mean, the reason I left the large public company world and started doing this was there was too many startups out there who just didn't have the expertise around them to navigate issues like this, whether it was marketing, finance, or legal. You always had to go external for that, and people that had the large company and startup experience, either you had to hire them full time or you had to go to a larger firm and pay $600 an hour or something outrageous like that. So happy to help you guys as much as I can. Good luck to you. Hopefully you're one of those industries where this is working out well. Hopefully your investors are still taking meetings. If not, try to hang in there and go after these government programs. If there's anything I can do to help along the way, please feel free to reach out to me.
Thanks so much, Keith. Well, we appreciate you coming in. What I'll do, if it's okay with you, I'll go ahead and toss your LinkedIn here in the chat once I do all this. I'm also going to toss in a couple of links to some events the DEC has going on this week, as well as the mentor program we have launched. So any of you guys that are still in here, please feel free to check out those links and those resources. I'll do it within the next 2 or 3 minutes or so. So if you stay in the chat, if you stay in the events, those will be in the chat, and we appreciate you guys tuning in, and please reach out to the DEC if we can help you guys at all. And thank you again so much, Keith.
Thank you. Thanks, Delaney, and thanks. Always happy to work with the DEC.
Yeah. All right, guys. Bye.
Bye, guys.